Ever wonder what makes a truly global company tick? One of those beverage giants.
Absolutely.
Well, today we're diving deep into Asahi Group.
Catchy mission, right?
Yeah.
Deliver on its great taste promise and bring more fun to life.
And they're not just saying that. We're talking over 10 billion liters of beverages every year. Beer is their bread and butter, you could say.
Definitely their core strength.
So for this deep dive, I shared their 2024 integrated report with you.
Right, the annual report card, plus their roadmap for the future. So think of this as our mission to understand those core businesses, see how the numbers look for fiscal year 2023, and of course, how they plan to keep those profits, well, flowing.
Okay, so cracking open this report, the first thing we see is how Asahi is structured. They have these four main segments. The biggest one is Japan, Oceania.
Yeah.
Huge, right? Almost half their sales in 2023, 49.2% to be exact.
Impressive.
And their operating profit margin there, nearly 40%, 39.8%. Plus, it's where they have the largest chunk of their workforce, 41.9%.
Really shows where their roots are. And the efficiency of their operations in that part of the world, I'd say, that level of profitability, that suggests a really strong market position.
Then there's the Europe Southeast Asia segment. That's a big one too, 23.6% of sales. Still a really healthy operating profit margin at 36.8%.
Absolute.
And what I found interesting is they manage that with a much smaller portion of employees, only 14.4%.
Yeah, speaks to their efficiency there. Even with all the different market dynamics you have in Europe and Southeast Asia, they're clearly managing things well, maintaining strong profitability.
Now, the other segment, much smaller, 2.1% of sales, and a profit margin of 0.5%. 6.4% of their employees, though.
Probably a mix of smaller ventures, maybe some newer markets they're trying to break into. That lower profit margin could be those initial investment costs or just a different competitive landscape.
Makes sense. And lastly, we have Total. So this segment represents their global alcohol beverage business. Interesting to see this broken out separately, right?
Yeah, I thought so too.
24.9% of sales, operating profit margin of 28.3%, and 35.4% of their workforce.
Yeah, it gives us a clearer picture of how their core alcohol business is performing globally. Still solid profitability overall.
Now let's get back to that Japan Oceania segment for a second. Something really stood out to me here. They did their first beer price increase in Japan in 14 years.
Wow.
Back in October 2022. And it seems like it really paid off, boosting both revenue and profit throughout 2023.
I mean, that's a bold move after so long, right? But it seems like it really reflects Asahi's brand power, that loyalty they've built in Japan.
Definitely.
And maybe there's also a broader shift happening. Consumers willing to pay more for, let's say, quality beverages. Maybe it's an aging population with more disposable income. Or changing social habits, prioritizing quality over quantity. It's something to consider.
Interesting. Now, switching gears to Europe, Southeast Asia, we see a different story. Declining sales volumes. They're linking this to inflation, obviously, consumers tightening their belts a bit. But here's what they did. They got really strategic with their pricing. Increased unit prices, which helped them absorb those rising costs.
So they sold less, but each sale was worth more. Smart.
It's a delicate balance.
Right, sure. It shows their ability to adapt. Different economic pressures across different regions. I mean, normally everyone's aiming for volume growth, but they managed to maintain profitability by adjusting their pricing. You got to have a good understanding of a market to pull that off.
Now, in the report, the group CEO's message was all about accelerating value creation through global management evolution. Sounds very corporately, I know. But their focus on premiumization seems key here. They explicitly said it drove profit growth in 2023 across all categories, despite those economic challenges we talked about.
And that makes sense, because premium products usually mean higher margins, but it's not just about slapping a premium label on something.
Right.
So what's Asahi actually doing differently? What are those tangible things that justify a higher price tag for consumers?
I'm curious too.
It's a bit of everything, I think. Higher quality ingredients, obviously, maybe some specialized brewing techniques, creating unique flavor profiles, even the packaging, something that looks and feels luxurious. It could even be the brand story, the heritage they're selling. It's about creating that perception of value that goes beyond just the liquid itself.
Totally. Like think about Asahi Super Dry. That silver can is iconic. Or maybe it's the specific type of malt they use in their higher-end beers. It all adds up.
Exactly.
Their strategy seems to be built around 5 global brands: Asahi Super Dry, Peroni Nastro Zero, Kozel, Pilsner Urquell, and Grolsch. And the plan is to, well, sell more of them, not just in their current markets, but by expanding into new areas.
Makes sense. It's like having a team of all-stars. You can send them wherever there's an opportunity.
And it seems to be working.
I think so. I mean, these brands already have global recognition, right? A certain level of prestige. So Asahi can really leverage that to enter new markets. Plus, they get those economies of scale in their marketing efforts.
Now, speaking of marketing, Asahi isn't just throwing out generic ads. They're trying to connect with their audience on an emotional level, linking their brands with certain values and experiences. And a big part of that is sports sponsorships,
Right. Asahi Super Dry with rugby, for example.
which they see as embodying integrity and passion, according to the report. And then you have Peroni Nostro Azzurro, 0.0%, and their partnership with Scuderia Ferrari and Formula One.
Carefully chosen, for sure.
These partnerships aren't just about getting their logo out there.
Definitely not.
They want to align their brand image with certain qualities, like the precision of Formula One, the teamwork you see in rugby.
Trying to create a sort of halo effect, subtly influencing how consumers see their brands.
Exactly. Now, zooming out a bit, they laid out this medium to long-term management policy and their AGP model for corporate value enhancement. Bit of a mouthful, but it boils down to a few key pillars.
Creating innovative added value, procuring high-quality materials, respecting human rights, ensuring a stable product supply, optimizing production and logistics.
Sounds pretty comprehensive, but how does this actually play out in their day-to-day operations or their strategic decision-making?
Yeah, I mean, take that creating innovative added value, for example.
yeah.
It's not just about new flavors. It could mean new packaging, sustainable packaging, or even exploring entirely new product formats. Think ready-to-drink cocktails, maybe, or using digital tech to enhance the consumer experience.
So these pillars act as guideposts, essentially.
Right. For instance, the procuring high-quality materials responsibly part informs their sourcing strategies, how they choose their suppliers, and it shows consumers they're committed to ethical sourcing.
And all of this feeds into their ideal business portfolio strategy. Several key things here: growing those global brands, obviously, but also offering premium options through regional brands, catered to local tastes, expanding the non-alcohol and low-alcohol range.
Big trend right now.
Huge. And then, of course, offering products that support a more sustainable society. That feels crucial for any business these days.
It is. The non-alcohol and low-alcohol thing is clearly a response to changing consumer preferences, people more
Right.
health conscious,
Right.
and sustainability. It's not a niche thing anymore. It's an expectation. Consumers expect it. And it's key for long-term business, well, survival. You see it influencing everything from their packaging to how they make their products more energy efficient.
Okay, so we've got a sense of how they're structured, their game plan going forward. Let's look at those hard numbers for fiscal year 2023. Total revenue. A cool JPY 2,769.1 billion, a jump of 10.3% from the previous year.
Solid growth.
And they made a point of saying this wasn't just because of exchange rates. Even stripping those out, there was strong organic growth across their businesses.
So the core of the business is healthy. That's what that tells me.
Core operating profit also saw a healthy increase, up 8.1% year-on-year to JPY 263.7 billion.
Not bad.
Their core operating profit margin was 9.5%. That's including liquor tax, of course. But if you take that out, it jumps to 12.1%.
Which highlights the impact of those taxes. But either way, those are strong margins. Shows that their focus on premiumization and strategic pricing, it's really paying off.
Another big number is their free cash flow. It went up to JPY 252.0 billion. They say this is thanks to that increased core operating profit and also better management of their working capital.
Free cash flow is crucial. It gives them options, invest in future growth, pay off debt, return money to shareholders, you name it. And it helps them weather any unexpected storms. It's a sign of financial strength and efficiency.
Now, their profit attributable to the owners of the parent company came in at JPY 164.1 billion. That's an 8.3% increase. They also gave an adjusted profit figure of JPY 165.6 billion, which was up just 0.1%.
So the adjusted figure probably takes into account any one-off items, or maybe some accounting adjustments.
To give a clearer picture of their operational performance.
Right. So the core profit growth of 8.3% is probably the number to focus on. And they also mentioned they're getting closer to their target net debt-EBITDA ratio.
Good sign.
Means they're managing their debt well.
So to sum it up, what drove this solid performance in 2023?
Well, those pricing strategies definitely helped. They were able to pass on some of those increased costs to consumers, especially for those premium products. And of course, their ongoing cost management efforts across the company. Can't forget that.
It all adds up.
It does.
They also mentioned that the reaction to the beer price increase in Japan was better than expected. Seems like Japanese consumers were more willing to pay a bit more for their beer than they thought.
That's huge for Asahi. Japan is such a key market for them. It really boosted their profitability there.
And even in Europe, with those lower sales volumes we talked about, they were able to offset those rising costs through pricing.
Shows their flexibility, adapting to different conditions, protecting their margins even when sales are down. Plus, don't forget the overall trend we've seen. Consumers going for those global and premium brands. That's been a major factor in those higher profit margins.
Now, let's talk about you, the shareholder, and how Asahi plans to create value going forward. Their current approach is to find that balance between investing in future growth and making their financial position even stronger, especially after all those acquisitions they've done. Classic growth versus stability dilemma, right?
It is. And after all that growth through acquisitions, having a solid balance sheet is critical. But so is investing in organic growth, finding new opportunities. And it looks like they're on the right track. They're approaching their net debt EBITDA to target, which gives them more flexibility.
And speaking of acquisitions, they mentioned they might start making more of those starting in fiscal year 2025 as they get closer to that debt target.
So acquisitions are still on the table, but they're being smart about it, waiting until they're in a stronger position. I imagine they'll be looking for opportunities that fit well with what they already have, complement their existing portfolio and expand their reach.
Now, their top priority for using their free cash flow is what they call sustainable growth investments.
Oh,
Growing those existing brands, for example, strengthening their supply chain, expanding in those beer-adjacent categories.
things like ready-to-drink beverages, RTDs.
Exactly. Canned cocktails, hard seltzers, things like that, using their existing network and brand recognition to branch out. They're also focused on those non-alcohol and low-alcohol drinks, and of course, continuing that premiumization push.
All about building a more resilient business for the future.
And they also said they're flexibly examining capital policies such as shareholder returns, including treasury share acquisitions.
Share buybacks.
Exactly. So they're focused on investing in the business, but they're also thinking about ways to return value to shareholders, like buying back their own shares.
Which can be a good thing for shareholders. It reduces the number of shares out there, which can boost earnings per share, maybe even drive up the stock price a bit. Companies usually do this when they think their stock is undervalued or if they have extra cash.
They've also been steadily increasing their dividends. In 2023, they bumped up the dividend per share by JPY8 to JPY 121. The adjusted dividend payout ratio was 37%, and their goal is to reach 40% by 2025.
Steady increase like that. It's a signal to investors, shows confidence in their future earnings, a commitment to sharing their success.
They're already walking the walk, too. They've announced another increase for 2024 by another JPY 11, bringing it to JPY 132.
Which puts that payout ratio at 38%. They're moving in the right direction. These consistent increases are tangible returns for shareholders, and it's a big part of their overall value proposition.
When it comes to cash flow, their target for 2024 is JPY 225 billion, and their main priority for using that cash is to keep paying down their debt. Deleveraging is still key.
Smart move. Reducing debt makes them less risky. They'll have lower interest expenses and more flexibility to invest or return capital to shareholders.
So, big picture, what's your take on Asahi? Where are they headed?
I'd say things are looking up for them. They expect a more stable operating environment in 2024, which is always good. And they're planning to stick with their current strategies. They seem to be working, keep that growth going, keep improving profitability.
They're also planning to increase their capital investment in 2024, up to JPY 139 billion, targeting things like digital transformation and sustainability initiatives. They see those as essential for long-term value, and they expect to maintain similar investment levels going forward.
So they're not just thinking short-term. They're investing in the future of their business. Digital transformation can make them more efficient, more innovative. And the sustainability stuff, that's just smart business in today's world. It opens up new opportunities and addresses those growing environmental concerns.
And their medium-term goals. They're aiming for high single-digit annual growth in both their core operating profit and their adjusted EPS.
Ambitious? Sure, but I wouldn't rule it out. Especially if they can maintain this momentum with their premium strategy, expand globally, keep those costs under control.
And they're definitely laser focused on that solid financial base, maximizing cash generation. They're even looking at their production and logistics networks to see if they can squeeze out even more efficiency.
Constant improvement. That's what you want to see. It's about creating a more efficient cost structure, which helps support those profitability targets.
Their long-term goal is consistent free cash flow of JPY 200 billion or more each year, which makes sense. That consistent cash flow will be vital for all those plans and for rewarding shareholders.
Exactly. It's the engine that drives everything.
They also touched on managing financial risks, things like potential impairment losses from acquisitions or issues with sourcing raw materials, even exchange rate risks. They actually created a whole new entity specifically to handle procuring raw materials.
Being proactive, that's a good sign. For a global company like Asahi, managing these kinds of risks is so important. It's about protecting their profits, ensuring stability, and centralizing their procurement. It should give them more leverage with suppliers.
Makes sense. The group CEO ended his message by saying he wants Asahi to be a value creator globally and locally, growing with high-value added brands.
Keiichi.
Right. He emphasized providing premium value and constantly evolving their business to keep up with changing tastes and, well, how society views alcohol. They seem to get it.
They do. They're adapting, focusing on those health trends, the sustainability stuff, and they have a strong brand portfolio to work with. That's their recipe for sustainable value creation.
So to wrap it all up, Asahi had a strong 2023. Smart pricing, their focus on premium brands, and their global reach. They're finding that balance between investing for future growth and giving back to shareholders. Dividends are increasing, and they're being smart with their capital, all while navigating a constantly changing market and keeping an eye on that all-important sustainability aspect.
Couldn't have said it better myself. They've shown they can adapt, be resilient. They've got a clear plan for the future. And their focus on premium products, those key global brands, and their disciplined approach to finances, that's setting them up for success.
Now, one final thought for our listeners. Asahi is going big on global expansion, and they're really embracing that sustainability trend. So what could be next for them? What new types of drinks could they explore? Or maybe some surprising new markets they could enter? Something to think about. And as always, thanks for joining us on The Deep Dive.